This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Before I jump into my guest today, a favor, a request, often made. If you like this podcast, go to iTunes, write a review for your time and toil. If you write the review, even if you despise my podcast, even if you can't stand it, write a review. Actually, I don't want you to write a review if you actually despise the podcast, but if you like it, write a review. I will send you a DVD of Trend Following extras. All you have to do, write a review, drop me an email, send me your address, anywhere in the world. Boom, boom, boom. Real easy. My guest today is Gary Antonacci, 35 years as an investment professional, quant guy, focusing on two things in the quant world: relative strength, price momentum, with trend following, absolute momentum. He's developed a strategy where he believes it's best to combine both. Today, Gary makes the case for his strategy. I hope you enjoy this conversation. Gary, so you're right in the middle, along with me, with this area of momentum and trend. And I thought I would let you right out of the gate clarify what I often see as confusion, either in just common trading parlance or academic parlance. And that is the notion of momentum. Because sometimes I think people are talking about the same thing, whether it's trend or momentum. And I think there's different vocabulary, there's different parlance, different jargon. How do you see that in terms of trying to get the audience past confusion? I typically, in my world, have not used the phrase momentum, but as I was going through your book, I start to think, well, I see what Gary's doing. Maybe that is the right phrase to describe the act of the movement. But how do you see this, Gary?
Well, unfortunately, as you say, momentum does have a number of different meanings depending on who you're talking to. Where it came into play first was actually with practitioners. And this was during the dot-com era especially. People referred to momentum as just any kind of an approach that went with high-profile, high-performing type securities. Unfortunately, in the academic world, they use the same word to mean something a bit different. So in that sense, relative strength is the same thing as momentum. However, academics didn't want to adopt that term because one of the early people who tried using that was not accepted very well for his work. That was Bob Levy. So they came up with the term momentum, not giving any consideration to the fact that it meant something different to practitioners. To make it even more complicated, there's actually two types of momentum now identified in the academic world. There's relative strength momentum, which everyone seems to understand. Sometimes, though, that's called cross-sectional momentum because they're referring to segmenting the U.S. stock market typically into segments and comparing the strength of the strongest to the weakest. On the other hand, there's what I call absolute momentum and what academics call time series momentum, which I think is a misnomer because all momentum is based on time series, which are prices. But time series momentum, or absolute momentum, as I call it, and others call it, refers to trend following. And instead of comparing the performance of one asset to another, you're actually comparing the performance of an asset to itself over a certain period of time.
That's a great way to start this because that does clearly put out there, and obviously by the title of your book, you're looking at both approaches, and we're going to get into that. But I think it's a great way to let the audience clearly see the two different types of thinking.
And I think relative and absolute momentum makes sense when you're talking about it because everyone's already used to hearing about relative and absolute returns. And so in those two expressions, we have something very similar, where one is talking about performance relative to a broader universe, and the other is talking about performance just based on itself.
You know, in my world, too, one of the struggles that I have with jargon is the term managed futures. And so many people attempt to call the momentum strategy in my world trend following. They attempt to always call it managed futures. And I'm like, hey, hold on. Managed futures doesn't tell me anything. I don't know what that means. That could be innumerable strategies.
That's right. And I worked as a commodity pool operator, and I saw that firsthand. It would involve many different strategies. Trend following, of course, is a dominant one in that field.
Hey, let me go back a step in time. As you mentioned some of your early career, what is your early career? When did you first, and I've asked this question of many people when I have a trend or a momentum interview, when's that first moment where you said, oh, wow, this is not just the quote Warren Buffett value way. This is something different. What was your first exposure? Who brought it to you?
It's interesting you should ask, because I don't think I've ever mentioned this before, but when I began in the investment field in 1974, like many others, I was hired as a stockbroker by Merrill Lynch. At that time, everyone was basically promoting stocks based on Merrill Lynch research in the office there. But there was one particular broker in the office who was more successful than anyone else. He wasn't that old, so it was unusual for him to have such a large book. So I would stay around late in the day, and he'd usually be there, and we became friendly. And over time, he calls me over one day, and he says, "Come over here, kid. I'm going to show you what I do." And he pulls out these stock charts. He goes to the page that has the moving averages on it, and you really needed stock charts back then to even know what a moving average was. There were no computers or data feeds or anything like that. So he starts showing me the Dow stocks and how many are below or above a 39-week moving average. And he says, okay, and I forgot the exact number, but when he gave me the criteria, and he says, when this happens, I go out and I pitch stocks to people. And when the other situation exists, I sell them bonds or something else. So I went and got my own price charts and went through them and did my own research, and sure enough, this seemed to hold up really well over time. So that's when I started giving some consideration to this, and there wasn't much out on technical analysis. There was Edwards and McGee, I believe it was, which was a good book. And then I started looking at futures because there seemed to be more people doing trend following technical analysis in that area. And Dick Donchin was the one who was actually putting out some information and some research. And I started seeing what was being done with moving averages and channel breakouts and the whole broad spectrum of trend following methods. After that,
you're right on the money in terms of Dick Donchin, and I guess his first futures fund would have been in the 1950s. But I'm imagining, you say 1974, and you found Dick Donchin. This wasn't the age of the internet and research, so I'm guessing you had to poke around quite a bit if Dick Donchin was the only guy doing this, it wasn't like everybody knew who Dick Donchin was.
That's correct. I had to poke around and find these pamphlets and obscure publications. A few years later, I became a commodity pool operator. Of course, there were people using trend following then. I was one of the early people putting money with Paul Tudor Jones and John Henry, and I even met with Richard Dennis prior to his doing the turtle thing, and he was managing money for me.
That must have been a really interesting early experience. You just mentioned three names that all have had legendary careers.
That's right. It was very interesting to see the similarities and the differences in their approaches. They were all following trends in the market, but they were going about it in different ways. That, to my thinking, that created opportunity because there's diversification in method as well as markets when you do something like that.
Did you find that we're just kind of chit-chatting about this, but did you find even going back then that their methods were terribly different in the sense that weren't they getting similar results though?
They were getting good results. Paul Tudor Jones was getting fantastic results back then. He was the best trader I've ever seen. He just had a knack with the markets. Sitting and watching him trade was an incredible experience. Richard Dennis was a terrific floor trader. He wasn't as successful when he went upstairs and tried to do it himself until he later systematized it along the lines of the turtle type of trading. John Henry was always pretty good with his methods, and there are others too. I just mentioned three of them. But.
No, it's just fascinating. It's a nice firsthand position to see and learn as a young man.
That's right. Because I had rejected the idea of efficient markets, turned down an opportunity to get my PhD at Chicago in finance, I was always kind of wondering if I had made the right decision. Well, after I saw what these people were doing and others, I didn't look back after that.
You bring up exactly where I want it to go, which is the efficient market hypothesis. You mentioned Chicago. I can think of Eugene Fama. Reminded of the statement, I've seen it before, but right there in a nice narrative in your book, momentum is pervasive. So he's acknowledging it. And even though they hand out Nobel Prizes that seem to be schizophrenic in the last year, with one going to Schiller and one going to Fama, but Fama says momentum is pervasive. But then there's the efficient market hypothesis. It really seems like the foundations of so much investing theory in the last bunch of decades was a foundation that was less than solid.
Oh, certainly. There have been a lot of holes poked in the efficient market hypothesis over the last 20 or 30 years. But even from the beginning, it was never all that solid. It was just a convenient way of thinking about things. And some of the overriding principles made some sense in that it is hard to beat the market. And you need to keep your costs down. Things like that came out of financial research, so that was good. But the idea that markets process and reflect all information and that you can't gain an edge on the market, that's just not true.
The people that were the proponents, in your experience, how did they leave the holes out there? I mean, a guy like Eugene Fama, I've not met, I've not spoken with. I'm imagining he's a very, very smart man who has looked at many details, but it seems like such a massive hole to put out this one perspective about how markets operate, then to acknowledge that its momentum is pervasive and to not necessarily have an answer for it.
Well, Fama's an empiricist. His point of view, overriding point of view, which you can't fault him on, is that you do your research and you try to learn from it. And in fact, a great statistician, George Box, once said, all models are wrong, but some of them are useful. So I think when you look at it from that point of view, the work that was done in finance was useful. But when you look at it in terms of people taking it literally and ignore everything else, then I think it hasn't been so useful.
You've put an entire work together discussing and breaking this down with the academic research, but let me give a big picture concept, and let's talk about this a little, break it apart. I don't think for the vast majority of the investing audience, this is still understood, what I'm about to say, or do they relate to it? Doesn't make gut sense, intuitive sense, but this is the root of momentum in terms of the actual trading, which is buying higher highs.
Yes, that's correct. Basically, you're trying to get in tune with market forces. That's what momentum is all about, whether it's relative or absolute. You want to be in tune with what's going on in terms of the underlying forces that exist in the market. Markets do tend to underreact initially and overreact on a longer term basis. That, in a nutshell, is the basis of momentum. Now, you can try to explain it in different ways. Some of the people who still accept efficient markets try to come up with the rational basis to explain it in terms of, well, you're assuming more risk. That's why you earn more return. But that's a tenuous argument, because you can earn abnormal profits from momentum without seemingly assuming more risk. So I think behavioral finance has played a big role in getting people to accept momentum and accept trend following to a greater extent than they did in the past as well.
Well, it's funny that they might make that argument about risk at the higher highs, but if, for example, we're using the U.S. stock market as a case in point, they would say, well, if it starts to come down and then it's cheaper, I can buy more. But there's a lot of risk in going that type of way in the value perspective as well. If you were just to play devil's advocate.
That's true. Trying to catch a falling knife is always dangerous. Where value may have some value is on a longer term basis. When you're looking at 3 years, 5 years in terms of mean reversion of the markets, people do tend to, again, overreact, and sometimes prices can get depressed, but that's not on a short term basis or even an intermediate term basis so much. That has to do with longer term look at things. So momentum kicks in when you're dealing with, say, 3 months to 12 months of past history. Mean reversion or value is more of a 3 to 5 year or longer type phenomena. And then very short term, you can also have some mean reversion. So the markets do tend to overreact and bounce back on a short term basis of days or weeks as well. So it's interesting trying to sort out and blend those three things together.
You're going to have to excuse me for jumping around, but your book covers a lot of territory.
Yes, it does.
Hey, listen, let me jump into something that I think just is it's in the middle of this whole conversation. I just want to bring it up because I think a lot of people hear about it. They don't know what it is. And I thought you gave a pretty clear explanation, or at least saying, hey, maybe it's not the mother's milk, so to speak. You didn't use that term, I am, but which is just the notion of these risk parity strategies, and Ray Dalio at Bridgewater being the main one. Why don't you talk about the notion of a risk parity strategy, what it is, the pros and cons?
Risk parity started out as an interesting idea, like a number of concepts in finance, that being the traditional 60-40 balanced, so-called balanced stock bond portfolio was not really that balanced because the high volatility in equities mean that it represents a lot larger amount of risk in the portfolio. And that's true, but what do you do about it is the question. So what risk parity people try to do is greatly increase the fixed income side of the portfolio. And sometimes they add in some other things for diversification value. The idea being that if they can have a more balanced risk profile, then you would have some consistency, more consistency over time. There are several problems with that. First of all, they're looking back over the last 30 or so years and trying to get some idea what the future might be based on that. And during the last 30, 35 years, we've had a rip-roaring bull market in bonds. So extrapolating that into the future can be pretty dangerous. That's one problem with it, and it's a serious problem. So you're really just substituting one kind of risk for another, in that there's some uncertainty about the future relative to the past. The other problem is that in risk parity approaches, because you have so much fixed income, usually there's a target return level you're trying to reach. In order to do that, you usually impose leverage on your portfolio. And this creates other risks, of course. There's risk of liquidity, being able to get in and out of positions on a timely basis. There's the risk of leverage itself when you have some uncertainty, like I just mentioned, about what the future might be like.
Gary, let me jump back at you on momentum, especially in academic circles. I'm curious from your perspective, and there's quite a bit of academic work in your work. Have the academics been won over to the idea of momentum, or are there quite a few still debating it, not willing to accept, still saying, this is voodoo, such and such? Or have they been won over that there's something there and now they're trying to figure out exactly what all these traders have known for decades?
I don't know any academics who doubt relative strength cross-sectional momentum. That's just been so pervasive throughout the literature. You would be an outcast now if you doubted that. Trend following absolute momentum, that's a different story. The academic side of research on that hasn't been as prevalent until recently. So there have been a few papers out on time series momentum. Andrew Lowe's done some great work on identifying technical analysis and trend following as maybe having some substance. There's a book out by Gracerman and Kaminsky that looks at trend following over the past 800 years. So it's hard to ignore things like that. So I think it's a matter of time before trend following is accepted more on the academic side of things, but there's been a long history of it being regarded as voodoo. That's not going to change overnight.
Well, it's funny you mentioned Gracerman and Kaminsky. I've had them both on my podcast to talk about their book, and I didn't want to bring it up necessarily unless you did, but it feels like it's right there in the same space of your work. You guys are both, all three of you have taken that deep dive into a subject that a lot of people have not jumped at academically.
Well, even AQR and the academics over there, they've put out some work on trend following. There's a paper by Hurst, Oy, and Pedersen called A Century of Evidence on Trend Following Investing, in which they look at 100 years of absolute momentum applied to different markets. They find that it's done remarkably well.
And you've found, though, you like the idea of combining the two, whereas in my world, I've been a proponent of the trend following side of it, the absolute momentum side of it. You like the idea of combining the two.
Yes, you get the benefits of both without any drawbacks. Relative strength momentum and absolute momentum can both enhance return. The problem with just relative momentum is it does little or nothing to attenuate the downside. So you still can have large drawdowns and high volatility. And when you put in absolute momentum, that takes care of the risk management side to a great extent because you can attenuate the bear market drawdowns based on the past anyway.
Talk about the two strategies, the two momentum strategies from your perspective. Talk about their interaction in terms of correlation. How do they correlate in terms of their performance?
Well, they're not highly correlated. That's another advantage. And you can find that in some of the academic papers where they do look at that briefly. As far as I know, I'm the only person who combines the two together in a systematic approach. The idea being that you use relative momentum to pick between a universe of investment opportunities, and then you use absolute momentum, trend following, as a filter to see whether you want to be in that opportunity at a given time or you want to stand aside or be in something else that has both types of momentum positive.
What's the challenge in combining these?
The big challenge is structuring portfolios, and that's something that not enough people have given enough thought to. There's also the challenge of, with any systematic approach, of overfitting the data. So what I try to do is use academic research as a foundation, and I don't want to deviate very much from the parameters and the findings that academics have found going back 100 years or 200 years in the case of relative strength momentum. I try to adhere to that. I try to keep with models that make sense when you think about it logically. And I try to use some intelligent portfolio selection criteria. For example, U.S. equities have the greatest risk premium over time. You can look at Jeremy Siegel's book, Stocks for the Long Run, and see that documented nicely. That you don't do much better than that. So I want to have U.S. equities be the core holding of any investment portfolio that I have. There are other assets that people sometimes use to diversify with, that the risk premium is questionable or dubious. And I see that all the time. So sometimes people will over-diversify. They think more is better. That's not necessarily the case. I think you need to take an intelligent, selective approach to portfolio structuring.
I'd love for you to talk about the opportunities. And for example, look at 2014, equities hitting all-time highs. Very few people, especially after the last bunch of years of we're talking about absolute momentum or trend following, so many articles about the death of trend following. It's over, it's over. I don't think many people would have expected the absolute momentum side of the equation to have such great performance in 2014 in the face of stocks still staying at all-time highs.
Well, the market climbs a wall of worry, as they say, and markets tend to always go further than people expect or anticipate. I learned that firsthand as a commodity pool operator. There's a well-known practitioner, it may be Ed Secoda, I believe, who would put a price chart up on the wall. He didn't care how high it was. As long as it was going up, that became an attractive investment opportunity, because you never know how high it's going to ultimately go.
Well, I think what's even interesting, too, about 2014 is with stocks staying at all-time highs, it was the other markets, the dollar move, the yen move, the oil move, that produced such massive opportunity, even though just the typical buy and holder would say, well, why do I need all this other stuff? I've got my long-only equities, and it's doing fine. But I think even, and I give a little shout out to like Nassim Taleb, which is from an anti-fragile type standpoint, yes, you're long stocks and stocks are doing great right now. But my gosh, have you looked at the past history in the last 15 years? We've had 50% drawdowns. Why not consider something that considers that we've had those 50% drawdowns and takes into account the idea of finding a good opportunity? But, so many people get caught up with the idea of like, hey, it's at all-time highs. What can go wrong?
Well, Warren Buffett said that diversification is for people who don't know what they're doing. I think that's a little bit of an exaggeration, but in line with that is the expression, put your eggs in a basket and watch that basket carefully. And that's what absolute momentum does. That's what trend following is supposed to do. It allows you to stay with the market when it's going up and to hopefully gracefully exit when it's not going up anymore.
Gary, what have I missed in this whole subject? I mean, we can go on for a long time. We could talk all day and pick apart your work, but what are your favorite things? What do you think I've not talked about today that really keeps you awake at night, that you just love to ponder yourself?
Well, I think people need a new paradigm. The old paradigm is let's go out there and let's diversify into stocks and bonds and everything else in the kitchen sink, and we can reduce our risk exposure that way. Well, what you're doing is you're reducing your potential return that way by going with assets that have lower expected risk premiums, lower expected future returns. So I think people need to think more intelligently about investing and keep an open mind to what to them may be a new approach, but which isn't new at all. Relative strength momentum was uncovered in 1937 and published by Cowles and Jones, and was ignored for 50 years after that. Trend following has been around since Jesse Livermore and before that.
Gary, the book is everywhere on the Amazons around the world. Dual Momentum Investing. Anywhere else we can send people?
There's my website, optimalmomentum.com, and I have a blog, dualmomentum.net, in which I try to update people on momentum developments.
Gary, listen, I appreciate you coming on today. Appreciate you getting up early there. Were you in Vancouver today?
Yes.
Is that home base for you?
Well, I spent some time in California. I like to be in more than one place. Like you, I have the travel bug at times.
Yeah, it's hard. Once it gets in your blood, then travel is fantastic. And you mentioned living in India, but just travel is fantastic. The thing about travel, though, that the only, I don't want to call it a negative or a sad part, but it definitely lets you know deep in your gut about mortality, because you start to realize from a time perspective, you can't get everywhere that you'd like to go.
That's true. And I found my own experience is good to settle into an area and really become part of the local culture, what's going on. So I don't live like a tourist. I'll go there and I try to, fit in with the people there. And I found that to be really rewarding.
Yeah, I agree with that strategy completely, because sometimes people will say they've been somewhere and you say, how long have you been there? And they, I was there for a week or 5 days. And then they attempt to tell you everything there is to know about the culture. And anyone that has any experience says that's just not accurate. You can't know anything. You can't know any of the real stuff within 1 week. It's impossible.
Not even 1 month. I found it's really good just to, move somewhere and stay there for a while. Yeah. And you really gain a lot culturally that way, I think. What other places have you liked besides Vietnam?
Well, I've done a lot of traveling around Asia. I can't say that I've lived in the other places, but I've been to many. I mean, for example, I think Tokyo is going to eventually get me. The food is fabulous. I really do like the city. I think Tokyo is going to get me. Some other places, I admire Singapore, and I would even tell my Singaporean friends, I said, I might get bored here.
Yeah. Yeah, I can see that too. I have a friend who lives in Tokyo, and he's married a Japanese woman, and he loves it over there.
Yeah, it's a real fabulous place. I think from a civilized standpoint, and this might ring untrue with some people that have not traveled, have not been there, but from a civilized standpoint, the masters of toilet technology to begin with, the Japanese, and then you add to the food, they're just they really are. They've really got things down to a science on many things in modern everyday life. So, hey, listen, I won't keep you. It's early there for you. Gary, I appreciate you coming on. The book is Dual Momentum Investing. It's everywhere. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.